Okay, let's go. Whatever. Let's
Ready?
go.
Okay. Good morning. My name's George Ristau, and this is another edition of All Pro TV. Today's October 22, 2019. We're here after dodging a few raindrops on the way in to the office with our coordinator for our social media here at Weichert Realtors All Pro, Gino Pronos.
Hello, hello.
Good morning, Gino. And thanks for getting up early after a late training session last night. So glad to see you up and glad to see you rolling here this morning. And our our guest today is Ron Ricchio. And Ron has been with us a couple times before, but not in our new studio here. And we appreciate Ron being here. Ron is Ron is the owner of Chicagoland Home Mortgage Services, and he's been an affiliate connected and our preferred lender here at Weichert Realtors for several years. And good morning, Ron.
Good morning. Good morning. Thanks for having me this morning.
All right, great. So we're going to get a little bit of a feel for what's going on in the lending marketplace today and what we're looking at over the next few months going into the typically holiday season, if you want to call it that, and see how that has an impact on our real estate side of the business. You might note that I have my orange cup here filled with water, and the significance of that would have been to celebrate a Bears performance over last weekend. That did not happen. Unfortunately, we're not going to be talk radio today, so we don't have to rehash all of that. But we would be remiss if we did not mention the Fighting Illini, who had a big upset win over the weekend.
Tremendous.
Knocking off Wisconsin. And Ryan, you have a senior down there right now, so give us your perspective on his experience down in Illinois.
Oh, he's had a wonderful experience down there. He's majoring in finance. He's in the Gies College of Business down there, and just having a very great time, a great experience in the College of Business down there. And what a great win for the Illini this weekend. It was their homecoming weekend to beat the Badgers. I mean, that was pretty impressive.
Yeah, it was good, and of course I try to see most of the game, and I'm not getting any kind of credit for this one because I watched from the start at 11, and then I had a scheduled appointment at 2:00. Typically the games are over by 2:00, and ultimately I left from watching the game at about 1:45. The Illini were down 9 with 7 minutes left, and didn't look very, very good. And then when I got out of my appointment at about 3:00 or 3:15, I had a text from my son Mike. And Mike works here at the office with us. And Mike's text said, "Get Lovey an extension." So at that point, I was not sure if the Illini had pulled an upset or if Mike was just being facetious. But in fact, the Illini did pull out a last-second win with a field goal. So again, great news for that program and his fourth year. And good luck to the Illini, and good luck to Lovey Smith for the remainder of the year. Hopefully, they can have a good performance as they move forward and hopefully get a shot at a bowl game. They need 6 wins. They have 3 now. So we'll have more updates on that for our next edition of All Pro TV, maybe in about a month or so. Gino, any thoughts on football at this point for you?
Bears are disappointing.
Yeah, it's been
don't even want to talk about it.
And we don't want to talk about it, and sometimes things are better left unsaid. So let's flip over to lending today. Gino, do you have a question for Ron to get things started?
Nothing in particular. What do you got?
For me today, I think that it's always great to have Ron in because Ron's an expert in his field and has been doing this for over 20 years, Ron?
Yeah, almost 30 years.
Almost 30 years.
My 29th year.
29 years of lending.
Like a dinosaur.
Yeah, well, when you start in junior high, you can still preserve a long lifetime in this business, Ron. So you've seen a lot of different things. What I'd like to talk about probably first is the seasonality of our business, and this can kind of go to agents, any of our agents from Weichert All Pro that are watching today, or anyone else that might see this. Give us a little bit of a perspective of whether you see things typically running on a seasonal basis, or if it runs this year's running kind of counter to what you normally would see.
So typically we're seeing that this time of year going into September, October, there's just a natural slowdown in terms of residential sales going into the end of the third quarter, into the fourth quarter. And I think this year is no different than previous years. We are seeing a slowdown. A lot of the agents that I work with have talked about that the last few months they have seen a reduction in volume. But I am feeling very good about going into the holiday season and also going into early 2020 in the spring market. Rates are still very favorable. We've got 30-year fixed rates that are below 4%. We got as low as 3.5%. Probably about a month ago, we're now as high as 3.875, 3.99. The 15 years has been as low as 3% in some cases. So I think going into the spring market, I think it's a great interest rate environment that I think is going to have some great numbers for realtors going into spring of 2020. We're expecting them to stay relatively low. We're expecting them to stay in a certain range. There are some things that we are watching very closely that could change that. One of the big things is the trade war and the trade policies that are going on right now. If there is an agreement put together, we're potentially going to see equities go up, and we're potentially going to see interest rates go up a little bit because the Federal Reserve has been lowering rates based upon the unknown with the trade war that's going on right now. We do think that it's going to potentially carry into the fourth quarter and in the beginning of first quarter next year. So we like where rates are at. We think it's a great environment for realtors to be selling, and we're expecting a very good 2020.
Okay, great. When you stopped in the office, probably now 2-3 weeks ago, and you had rate sheets, and one of the sheets said FHA program, which was at 2 7/8 at that time. Where is it today?
So today's FHA 30-year fixed is about 3 1/8 to 3 1/4.
So still very, very attractive.
Still very, very attractive. And that's a great product for first-time home buyers and move-up buyers that you can buy a single-family home, 2 to 4 unit with as little as 3.5% down. So being able to get that kind of an interest rate and buying something at this point in time, especially now going into the fourth quarter where there isn't as much demand, typically you might get a little bit better price on a property.
Sure.
And then you couple that with a great interest rate, I think is a great time for people to be looking now and buying now.
Right. So do you think that you've already talked about where you feel rates are going to be? No one, of course, has the crystal ball on that one. But in your experience, we haven't had rates at this level for quite a while, right?
Yeah, the last time we saw rates this low, we saw them for a brief period in 2016, and then we saw them for a longer period down around these levels in 2012 and in 2013, back when there was the economy was just beginning to recuperate from the financial crisis back in 2008. I think longer term, or looking into 2020, the latter part of 2020, if things remain the same and we begin to see unemployment go up a bit. So unemployment's at a 50-year low. We've been anywhere between 3.5 to 3.9 in terms of unemployment. If that begins to go up just slightly, 4.1, 4.2, 4.3%, we could see rates come down even more than where we're at right now. Because the economy right now is basically running at full steam in terms of unemployment. If we see that go up a little bit, it's going to take some wage pressure off of employers, and we can actually see, potentially a little bit of a pullback in consumer spending, which has been really the last leg that's been carrying the economy right now.
Sure. Well, one of the strategies then for any of our agents or any buyers that happen to be listening today could be let's look and let's buy in November and December when there's potentially surplus inventory that's in the market. We have more homes that have been left over this year. So there could be that opportunity then to go into the market and buy and get a good deal, right?
Absolutely.
And then what happens next year when the rates drop, if they drop?
Well, I get this question a lot from clients, and they say, well, should I be doing something now or should I wait until next year? So we don't know if they're going to go down next year. We don't know exactly what's going to happen. Everything is data dependent, and that's a lot of times what the Fed says too. Is people should take advantage of what's available now. If we do see a significant drop next year, there's no prepayment penalties on these rates. Right. People can refinance. bring these interest rates down, bring the payments back down. So it's a great environment. Today with where rates are at, it's a very, very good environment. If they happen to go up and never got any lower, it's still an excellent opportunity, but nobody should be holding off on doing anything right now if they're anticipating or thinking, well, maybe I'll wait to see if rates get lower. Take advantage of what's available today, whether it's a purchase or a refinance, and then we can look to lower interest rates and better the situation later on if the market does get better.
Yeah, many individuals have been able over the years to watch the marketplace. Keys always are to try to buy when the market is down. The market is really, in my view, kind of at a point of equilibrium right now. So I wouldn't categorize it as a buyer's market nor a seller's market. Although on the upper brackets, there's greater opportunities, let's say that, for individual buyers. But for first-time buyers, if they can find that opportunity in the marketplace and negotiate, again, everything goes back to these days trying to buy your profit into the transaction. So if you can negotiate a good price on the property, then you're always in good shape. And then ultimately, you'll be in a position to always have that opportunity down the road, maybe to refinance in the short term if that happened. One other thing that I'd kind of like to have your thoughts and maybe inputs in is, in my experience, and I've been doing this more than 29 years, I'd say that. It seems like every presidential election that I've been around, and I was actually started my business pretty much just getting my licensing for 1976 election. And then that was a Carter win, if you remember the name from your history books to our younger listeners out there. Jimmy Carter won in 76. And then in 1980, we had a difficult year in 79 and the next year in 81, but 1980, we also saw interest rates drop significantly in that election year. And it's pretty much held true through most of the this is presidential election years, that we've seen a lessening or a lowering of the rates. And my question now is that, so since the rates are low or very, very low right now, it kind of brings some credence that the rates could possibly jump up at some point in the near term, very near term, and then drop again next year. It just happens to work out that way sometimes. Politically, I'm sure it's advantageous for the 435 Congress men and women that we have, and for the 100 senators to have the economy being its best foot forward when we hit a presidential election year. Have you seen that trend pretty much yourself, Ron?
I have, and I think the difference this time around is that there's a few different things that are happening that we hadn't seen in previous elections. Mm-hmm. One is this trade war, and two is this impeachment inquiry that's going on right now. Right. So there's quite a few unknowns, and typically when there's some unknowns in the market, it's actually good for interest rates, because typically investors are going to flock to treasuries and mortgage bonds, and they're going to buy those and push the yields down, push the rates down. So it really is going to depend upon what's going to happen here moving forward. That trade war, trade agreement, if anything happens with China, is going to be the big impact moving forward. I think if we see the economy start to drift down, there's a potential that there's a deal that could be put together, which will raise equities and potentially raise interest rates for the short term, maybe for a little bit. And then I think moving forward, it's going to really depend upon what's going to be happening with the consumer and with unemployment.
Right. So as the individual buyer comes to you, oftentimes I'm sure that they'll say, "Well, Ron, what's your opinion? What do you think I should do there?" Because you're going to be their trusted advisor. Oftentimes they're in on a referral if before they get to the realtor. Even they may have contacted you and say, "Hey, Ron, you're an expert, or you're the most expert person that I know that's out there in my world," and then they'll look to you for some guidance along the way. A pretty typical situation.
It is. I mean, what we'll look at for buyers, excuse me, what we'll look at for buyers right now, if they're buying a multi-unit property or they've got some rental income, we kind of look to see their rate on return in terms of what they're going to be putting down, what they're going to be getting back in terms of rental income. Is the building going to be paying for itself? How much they're going to be paying out of pocket? For owner-occupied folks, we're definitely looking at things a little differently. They have to buy a home that they have to live in, so we just try to make things, and we try to guide our clients and borrowers to buy something where they're pretty conservative in terms of their numbers, because we are seeing in certain areas, we are seeing that qualifying ratios are starting to come down a little bit. So
Okay.
Fannie Mae and Freddie Mac, as well as FHA, haven't implemented it yet, but they're looking to start pulling back those qualifying ratios, and which is good. I think that's very good for long-term stability and long-term health in the mortgage market, in the real estate market, in the overall economy, because instead of making riskier loans, if they start to be a little bit more conservative, if things start to trend down in terms of the economy, where we may be headed towards a recession in 2020 or 2021, that will actually soften the blow, and it'll be less of an impact that we saw, back in 2008, when it was just a nuclear bomb, if you will, in terms of what happened in
Right.
the economy.
Yeah, let's always keep that in mind. But we need to keep in mind also that each individual is always going to make their own evaluation for where their personal situation happens to be. And the naysayers that are out there are often wrong. Occasionally, they're right. That's the unknown that we always face as we move forward with the real estate market and the marketplace itself. Because remember, we're speaking with buyers that are trying to make the best long-term decision that they can. In my personal view, I don't think there's ever been a better time, and I've said this many times before, but a better time to be really looking intensely at making a real estate purchase for a first-time buyer. Why do I like real estate, and why have I been in it for my career? I think it gives the average American an opportunity to take advantage of some of the benefits that are definitely out there in the marketplace. It's always that rent versus buy scenario that we look at. And when the buy scenarios that are there are at today's levels, then it's much more advantageous. When I broke into the game many years ago, there was a wide disparity between rents and the ability to purchase. So at that point along the way, it was not as clear cut, but it kind of makes common sense. If you have a small down payment available, you have reasonably good credit, and then you can get a home with all the benefits of home ownership, and you can keep that pricing in the same neighborhood as what you would be paying for rent. And you also have some tax benefits these days, not as much as they were in the past, but those benefits are potentially there too. To me, it's kind of a no-brainer to move forward.
Absolutely.
Agreed?
Absolutely. I mean, we're seeing in some cases, we're actually seeing the mortgage payments are less than what the rents are with a very small down payment. And what we've just seen, that rents continue to go up, and housing on the rental side is at quite a bit of inflation in it. So I agree with you. I think it's an opportunistic time for new buyers that are coming into the market to buy something as opposed to renting. And with down payments that are as little as 3%, 3.5% for FHA, as little as 3% for conventional. And for the veterans that are out there, it is truly a no-brainer, because you can buy something with 0% down. And you can do that on single units all the way up to 4 units. And you can buy with 0% down. We've actually had some instances where veterans have purchased 0% down. They've gotten a closing cost credit. They've actually walked away with money at the time of closing. So for veterans, it's tremendous. And even for conventional buyers and FHA buyers that have to come up with a down payment, on a $200,000 down payment, if you're coming up with 3.5%, that's $7,000. So that's really all you need to get into something that is that small in terms of purchase price.
Well, yeah, that's not a lot. When you mentioned just a few minutes ago about the term qualifying, what's the ratios, the qualifying ratios that are there? So let's put a practical example out there. Let's say that an individual that's going to be purchasing, or two individuals purchasing together, have $5,000 of gross monthly income, which would be a $60,000 total income for the year. So based on that $5,000 of total income coming in on a monthly basis, could you give us an idea as to what the qualifying ratios might be in today? You said that they've retreated a little bit, possibly from where they were, but breaking that down into what it would be for, say, a conventional or an FHA, ballpark numbers.
So for conventional, if you're looking at qualifying ratios right now, they really look at one ratio, which is what we call the back end ratio, meaning everything comprised in terms of their housing payment, monthly payments for cars, monthly payments for installment loans, even the monthly payments for credit cards. So we go off of the minimum monthly amount that shows up either on your statement or that's on the credit report. So typically right now, they're going up to 50% of your gross income. So if somebody's making $5,000 a month, you're looking at, they don't want you to have more than $2,500 a month in total payments, which is pretty aggressive.
That's very liberal from the day.
It's very aggressive. I mean, when I started in 1991, qualifying ratios were 28, 36.
28-36. That seemed like that was a pretty familiar refrain, let's say.
So if somebody's making $10,000 a month, they couldn't have more than $3,600 in total monthly payments. Now, if you're making $10,000 a month, excuse me, you can't have more than $5,000 a month in total payments. What Fannie Mae and Freddie Mac want to do is they want to cut that back to 45%.
Okay.
So to give you a little bit of a interesting perspective, back in 2007, prior to the financial crisis, that qualifying ratio had gotten as high as 65%.
Wow. Okay.
So we got to keep this. We have to keep this in mind too. Is that we're talking about gross numbers. So if somebody's making $10,000 a month gross, they're probably bringing home about $8,000 a month net. So we're talking about then you've got $8,000 a month net to cover $5,000 a month in payments. We don't take into account the utilities. We don't take into account car insurance. We don't take into account all your other expenses in terms of food or raising your family. So it is pretty aggressive. And I like what Fannie Mae and Freddie Mac and even FHA want to do. They want to cut this back from currently being, it's in some cases, as high as 50%. They want to bring that back down to 45%. FHA is as high as 55% right now, and they want to cut it back to 50%. So it hasn't been implemented yet. It's on the road. I think it potentially is going to start here in 2020, if not sooner. But I do think that it's something good. It's something healthy for the economy right now. It's healthy for our borrowers. I think kind of pulling back the reins a little bit is going to ensure we have some long-term stability in the housing market.
Yeah, that's great. The ratios obviously have increased dramatically from where they were. However, I think, again, our overriding benefit is when we get that 3.5% fixed rate loan, that loan is not going to change for the next 30 years. So if you're looking for a hedge against inflation down the road, to know that your P&I, that would be your principal and interest, is going to be a fixed number for the next 30 years, it gives you quite a bit of opportunity for stability because you know that rental scenarios are not going to be stable for the next 30 years. Anyone that's been a renter for the last 5 to 10 years knows that those rental rates have gone up appreciably along the way. So again, that's why, in my opinion, the ability to buy a home is a great opportunity, gives individuals a great hedge, for the future. At least you can have one item in your budget that's going to be stable. Of course, you do have real estate taxes that could be going up, which is a component of the payment, and insurance, which is a component of the payment also. So you have to take that always into consideration. I see today more individuals looking at real estate taxes as a factor in their purchase. What have you seen over on your side on the real estate tax on rent?
We have too. I mean, everybody's now taking a much closer look at those real estate taxes being, where they're at now and being that potentially they're going to go up. I think most people had a sigh of relief in terms of the real estate taxes in Chicago, that they didn't go up as high as some had anticipated. What's good is that people have to stay on those real estate taxes. They've got to make sure that they appeal the taxes, make sure that they're not overassessed to try and keep those down. That's something that people should be doing every time that comes up. But the thing that we're looking at now today, which is better than first or second quarter of this year, was home affordability. So we kept on hearing that in the spring market, in the first and second quarter, that as we saw prices go up and rates were still pretty good, not quite as low as where they're at today. But we were talking about that people were saying that we were hearing a lot of news reports that there was some concerns about home affordability, that people getting into the market were kind of starting to get priced out. Now, as rates have come down, that's actually helped that affordability. And I think people buying here in the third and fourth quarter, where prices are typically a little bit lower, puts them in a great position. So I think as rates go down, and if they continue to go down or stay at these levels, we're going to see more people that are going to be able to afford these homes. They're going to be able to qualify for these homes, even with potentially some higher taxes. And I think they're going to take advantage of these low rates, these 30-year fixed rates that are ranging anywhere between 2 and 7/8 or 3% on an FHA, all the way up to, let's say, 3.75, 3.875 on a 30-year fixed.
Good.
So effectively what you're saying is that for some buyers who might have been on the fringe as far as affordability goes with any particular home, maybe in the springtime they couldn't afford that home, but now here in the third quarter they can actually get into that same exact home because conditions have changed for them.
Absolutely. So we're seeing some softer prices, and that coupled with the lower interest rates is making that, the monthly payment picture a lot different than it was just a few months ago in the spring.
Yeah, because kind of touched on it earlier, but one of the most common things that I hear from especially first-time buyers is, should I wait or should I buy now? What should I do? And I think that's the perfect example of why you should not wait. Because if they wait, just 3-4 months and they start looking in the springtime, they might get priced out again, right?
Absolutely. And the market has been doing very well in terms of appreciation. And I don't have to tell you guys that. That's your market, of course. But on a national average, they've seen some very nice appreciation depending upon the area of the country. We're seeing anywhere between 3 to 6% in terms of appreciation, which is great. I mean, you're putting your money into a property, you're building your equity, you've got these tax write-offs that you get, you've got fixed rates that are near historic lows. So I think it's an opportunistic time for people to be able to buy now and get into the market. And if rates go down, it only gets better for them, because they can refinance and bring those payments down.
Mm.
Yeah. We've seen, and we talked a lot about first-time buyers. We also see the move-up buyer. So that's the first-time buyer that made a good move and bought in 2012, right? Or 13 or 14. And so now the time goes quickly. So 5 years later, they've built up a considerable amount of equity in their home, especially if they bought and leveraged their scenario and bought with 3% down or 5% down. An average purchase perhaps could have been $200,000 back then. And now maybe that house is worth $250,000, depending again on the marketplace. So all of a sudden they have instant equity. Right? Instant being a 4 or 5 year wait, but now they have a reasonably good amount of money available for a future down payment. So what are you seeing on the move-up buyers that are out there? Do you see that they are taking advantage of that opportunity in the marketplace right now, or are they kind of sitting on the fence?
No, I think they're taking advantage of it now, because back in 2012 and 13, rates were still very, very low. And when rates had moved up last year and they had breached 5% in 2018, people didn't want to leave that great interest rate that they had, the low payment that they had. I mean, unless they were forced to move, unless it was something in terms of a job move, or if they ended up expanding their family and they needed more room, people said, hey, we're going to hold on to this right now. I think the difference now is that with rates being down, people are saying, hey, I'm going to take advantage of this. And we have some great equity that they've built up since 2012 and 2013. And in some cases, you may have seen, anywhere between 40 to 60%, depending upon the area, in terms of how high these prices have gone. They're going to take that, they're rolling it over into their next property and getting an interest rate that they have that's very similar to what they have now.
Right. Yeah. So the interest rate factor is obviously always on people's minds, because it affects their that monthly payment. And that affordability, of homes. If we just reel back 1 year ago today, if we were here, and we might have actually been doing a few other things, or very early in the year. At this time last year, my recollection is that the Fed said we're going to have 2 rate increases, and the rate increases are going to be 5% approximately, or they were projecting 5% on mortgages, potentially to go to 5.5%. and that kind of was blown up to smithereens along the way. So as you were tracking that, and your business is very reliant on the rates, obviously.
Sure.
What happened during that time frame that you saw?
So we saw the Fed increasing rates last year, which, keep in mind, what the Fed raises is different than mortgage rates.
Correct.
So they raise what's called the federal funds rate, which is directly tied to prime, and the prime rate is directly tied to home equity lines. So when the Fed raises or lowers those rates, it directly affects commercial loans, car notes, things of that nature. But what had happened last year was just because of the Fed, just because of what the Fed was saying, that, hey, we see things moving in a good direction here. They started raising interest rates. And what happened was it really slowed down a lot of the purchase side of things, to where we saw this time last year, in October of last year, we were probably somewhere around 4.6 or 4.7. In November, we actually breached above 5%. And then we had this reversal this year, to where then now the Fed has started lowering rates. They've already lowered rates twice. And then potentially they've got another meeting coming up next week where there's another potential rate cut of about 0.25%. This is all done because the Fed is concerned that they want to keep the economy expanding at its current pace, or somewhat near to its current pace right now. They don't want to wait until things actually get into a recession before they begin to stimulate. So they're trying to keep things sustained and going as long as they can. And if we do start heading into a recession, that potentially it's just going to be a soft landing.
Right, and that R word that we don't really talk about too much in the business of recession is definitely something to acknowledge. That's just a normal scenario that happens, in economic times. Looking at the survey of over a 10, 20, 30, 40, 50-year history, there's always going to be some upswings and some downswings in the marketplace. And we've had many recessions over the years. We've also had appreciation. And what I've found is that individuals that run sometimes contra to what's going on are actually going to be the big winners in the game. So as that timing might come, if there is a slowdown in the economy, if individuals have capital still available, there are even better opportunities that are out there in the marketplace. And those are driven mostly by price rather than driven by interest rate, because the rates might be a little bit higher. Sometimes rates are a little bit lower, but ultimately that seems like that's where many of the fortunes are made in the business. Individuals buying, again, the proverbial buying low, and then trying to sell high. So I'm sure you see that all the time too with with the business.
We do, and you touched upon something important about the economy. This is a cyclical economy. So every 7 to 8 years, we do take a breather. Things kind of pull back. We do have a recession. They typically last around 18 months. We are now in our 11th year of this expansion. Albeit it was a little slow in the beginning, we are in the 11th year, and the Fed just wants to do everything that it can to keep things going. Inflation's very low, unemployment's at a 50-year low, and they just want to keep things moving along at its current pace. And like you said, I think it's a great time to buy real estate now. We don't know if the economy is going to go into a recession. Things may continue on, and we may see this expansion go on for many more years before we see a bit of a downturn. But real estate, like equities, are things that are long-term plays. So people should be buying for long terms, and we're going to have peaks and valleys in terms of the appreciation and price points. And I think if they understand that it's a good time to jump in anytime in terms of where the market's at, especially now when you get rates this low. You don't see them this low for that long. I think they should jump in and buy something as soon as they feel comfortable.
That's great. That's great. Gino, just as a moderator over here, we want to make sure that if you have a good question, you can chip in with something for Ron. So do you have anything else that's kind of on your mind?
Well, this conversation as a whole has reminded me how many factors really go into what's coming out of buyers' pockets, because it could vary wildly throughout the year based on various conditions. So, and I think most consumers don't really consider most of those things, but they're obviously extremely important to know. So it makes it all that much more important for them to get linked up with somebody like you, Ron, who knows what they're talking about.
Thank you.
Right. So, and you shouldn't go in alone. You shouldn't just be winging it because, something looks attractive on the surface, because there might be something that you're not considering in the long term. So, yeah, for me, overall, it just reminded me that everyone needs to become more of an economist before making such a big purchase like this.
Right? Absolutely. And we really try to do our very best to educate our customers on all facets of the real estate purchase. I mean, we look into their taxes and try to give them recommendations in terms of appealing those taxes. And we try to talk to them about interest rate strategies and closing cost strategies and things of that nature. So we think that, now is a very good time in terms of buying. I get asked the question a lot. Do you think we're going to see something similar to what we saw in 2008 when the financial crisis hit? And I tell my clients no, because real estate appreciation is based upon the type of financing that you can get. So 10 to 15 years ago, the financing that we had was extreme. We had these extreme mortgages with 0% down, there was no income verifications. All these things contributed to the housing prices going up as high as they did. Those mortgages are not here anymore. So you can't do anything 0% down with a no income verification. The subprime market is much different than it was before. People have to have a lot more skin in the game. It's anywhere between 20 to 25%. There are some no tax return type products, but that has to be supported with other things like bank statements. We actually have to see that money actually coming into somebody's account. So it's very, very different. So can I guarantee there won't be a recession in the future? No, there will. We will see some peaks and valleys in the marketplace, but it is much, much different than it was 10 years ago. People should not be worried about that at this point in time. If they're looking to make a purchase, that shouldn't be factored into their decision.
Well, one of the things that we've always looked at, which you brushed on earlier, was unemployment rates. And coming from the era of the 80s, we at that time, this is the 1980s, for just a historical reference. In that era, we saw unemployment rates that actually in the Chicagoland area were as high as 20% unemployment. This would have been stretching out more to the industrial locations like a Rockford and the like. But even in the city of Chicago and many of our suburban areas, it was not uncommon to see anywhere between 9% to 13% unemployment. And I think the thing that someone mentioned to me, I can't recall who it was, but it was a scholarly approach to it. If there's 10% of the population that's not working, everybody knows somebody. So that is like the other 10% effectively might be thinking about, hey, am I going to lose my job? And so that does create a certain amount of instability in the marketplace for trying to make a long-term decision.
Sure.
It's probably not sound thinking to think, hey, I want to buy a house and I'm going to lose my job. Now, back to your numbers today of unemployment, to me, working, having individuals that are out there and contributing is always a plus, because they're all paying taxes, and it should help our overall economy rather than being on the other side of the ledger. So you think unemployment is still one of the keys then, correct?
Absolutely. I think right now, unemployment being very low, and you're having the majority of the American people working, I think is definitely pushing things in the right direction in terms of appreciation and in terms of consumer spending, and the overall economy and GDP is definitely going in the right direction. Even if it goes up to 4.2 to 4.5, anything below 5% is still considered a very healthy market. So we're really running way below that. So that's another indication too that people should say, hey, I feel pretty comfortable right now where things are at. If God forbid I was to lose my job, that there's other opportunities that are out there and are available. I mean, it was in 2009, 2010 that we were approaching double digit. We were up in the upper nines in terms of unemployment, and people survived. And people at that point, to piggyback on your comment you made before, people that bought back then when pricing and the property values were low have really been rewarded now, seeing appreciation come up, and they're rolling that into their next purchase then.
Right. Yeah. As we do historical looks at properties when we represent a buyer, today, looking at today's market values, and then I roll back to, well, this individual bought the property in 2008, 2009. Now, 2008 is a little tricky because actually the marketplace in 2008 was actually rolling along until the crisis hit in September, I believe, of that year.
Correct.
And ultimately, you could have made a purchase in 2008 before the market decline started. But individuals then, 9 was kind of a transitional year to a certain extent. No one completely knew what was going on, except we knew that there was not very many loans that were being made in those days. And then 10 and 11 were, again, starting a slight rebound. And then, as you mentioned earlier, in 12. So we've had many, many years here for individuals to observe the marketplace. And hopefully they're going to be in a position that they're always evaluating where their position is. The purchase of a single-family home, in my opinion, has 2 major prongs. One, it's where I live. It's where I raise my family. It's where I enjoy my life. On the flip side, there's economic benefits along the way for individuals that may choose to say, hey, I like where I live, but maybe I can get a little bit better home or bigger home in that same neighborhood, or maybe I'm just going to go to a different location and take advantage of the amenities that are offered there. So that's the promise, I guess, that we bring with the real estate market, and having individuals like Ron Ricchio with us today and with our company certainly is a big plus. So Ron, I'll give you final comments if you would like to share anything else with the audience today.
Just final comments. Again, we think this is a great time. Home affordability's really come back. We think that here, the third and fourth quarter are great opportunities for people to buy properties now. Prices are softer than they were at the beginning of the year, and interest rates are better. So I think it's a great time if people are looking. The market is not as crowded, and I think they should jump in.
Okay, that's great. We hope all of our listeners have a great Halloween coming up at the end of the month. We thank Gino Pronos for putting today's production together. And again, thanks to our host, to our guest today, Ron Ricchio from Chicagoland Home Mortgages. Thanks, Ron.
Thank you, guys.